Joining me right now is ERShares CEO Joel Shulman. Joel, great to see you. Thanks for being here. CPI is already at a new four-decade high, and we're expecting a new four-decade high to be reached on Wednesday. What are you expecting the impact to be?
Yeah, I'm expecting actually inflation to have peaked. So we've been seeing a peaking in this period. I think we're going to start to see more evidence, particularly next month, but I think it's going to start perhaps as early as tomorrow that inflation has peaked. And I think the markets will see that as an encouraging sign. So we've been at these elevated levels for a while. As soon as we start to see information showing that inflation has reached the top and is starting to make its way down, as many expect to see better evidence in July, I think the markets are going to respond well, particularly the beat-up areas of healthcare and tech and high-growth stocks.
Okay, so what about second quarter earnings season, Joel? We're going to be hearing from CEOs this week and next in the coming couple of weeks about the second half of the year. What are you expecting in terms of corporate guidance now that we've got the second quarter behind us?
Well, it's going to certainly be modest. I mean, it's going to slow. We're seeing growth, in many cases, flatline for many companies. And we start this week with financials. And we saw last time the big news coming out of financials was that SG&A costs were skyrocketing, primarily because of the high cost of the labor. And that labor cost has not really come down yet. We're seeing layoffs increase, and particularly among some tech companies. We haven't seen layoffs really having an effect yet on labor costs. Those will probably be the stickiest, the slowest category among energy, food prices, and labor. Labor is the slowest probably to drop, and that's still going to stay elevated. We're probably going to see some weakness in the financials, particularly because the SG&A costs aren't coming down. We're going to see some of the revenue growth, certainly coming down. Some of the tech will will provide surprising results starting next week. They're able to keep the costs lower, and I think there's going to be a few cases of revenue going up and SG&A costs relatively going on a comparative basis going down, and widening expansion. We've seen this with NVIDIA and a few other companies where they've been able to widen or broaden the EBIT margins. Those will be good surprises to the upside.
Joel, what are you seeing at ERShares in terms of how people are moving money around? Look, we've already seen PepsiCo report earnings. The revenue was better than expected. This is a multinational. I wonder how much of a factor the strength of the dollar has been. I know you like tech. You're talking about a tech comeback, and that high growth tech will be great for the long term. But are you seeing that from your own ETFs and how money is being moved?
Well, money's moving in the last few weeks. We're seeing money move into some of these high growth, very popular ETFs with the focus on entrepreneurial, disruptive, innovative companies. And so there's some significant flows going in that regard. And that suggests that the markets may be perceiving, particularly among the retail audience, not the advisors, but the retail audience is moving money into the high growth categories. And we're seeing last month, especially among the small caps and the healthcare companies, the small cap healthcare companies, which have been primarily losers in terms of earnings. They're losing a lot of money. They had a significant recovery in the last month. Some are up 30, 40, 50, 60% or more in many cases. And so we're seeing more speculative names coming back, and we think that's coinciding with this expectation inflation. The worst is behind us. I'm not saying it's not going to continue to be bad, but many people are going to perceive that the worst is behind us. And that, to your guest's earlier comment before, the markets are forward-looking, and we think people are going to respond in a favorable manner for the second half of the year, despite the fact that the worst is now going to come in terms of earnings results and slower growth for many of the big companies, particularly multinationals. I mean, as you mentioned, the dollar's going to hurt them.
Yeah, the dollar will hurt them. That's what I was referring to.
Now, Joel, I mean, my question here is, could it be a dead cat bounce, right? We saw this back in 2000 when the tech bubble burst. Right. You did get a bounce, but, I mean, valuations are still pretty crazy. I looked at Chewy.com the other day, and it trades at like 1,000 times forward earnings. So even with this big correction, you're still seeing huge valuations. So I wonder here, I think you get a bounce, you're correct, but will it last? I'm a little suspect. I got to be honest.
Yeah, I'm not disagreeing, Ryan. There are still many elevated, valuations out there. But when you look overall at the Nasdaq, it's at its 40, 50-year averages, And by, there's always going to be little pockets of mispriced securities. We saw this before where market cap to revenue to market cap. I'm sorry, market cap to revenue is in some cases over 120, which is just unheard of on traditional measures. But we're seeing many companies on an adjusted price earnings basis, a PEG ratio, very reasonable and actually better value than some of the large staples like Target and Walmart. We're seeing Nvidia, for example. It's a situation where the price earnings to growth ratio is actually 1/3 what you're going to see with Target and Walmart. So we're still seeing some securities priced out of whack.
All right, we'll see what Walmart has to say. We're getting retail sales out on Friday, so that'll be another indicator of the consumer. Joel, it's great to catch up with you as always. Thank you, sir. Joel Shulman joining us this morning.
Thank you.
ERShares.